Good afternoon, everyone. This is workshop week 13, and and we'll be discussing about liberating capital structure, and another chapter we're going to cover today is merger and acquisition. So we're going to cover actually two chapters today. All right, so before I start the class, do you guys have any question to ask me? Any questions for me, guys?
I would just like to ask you, if you don't mind. I know I'm asking a bit early, but would you be able to give us or give me at least any the structure of the exam, how it's gonna be, or I'll have to wait till next week?
I think it's better to wait next week.
Okay.
All right. Anything else?
All right, so will the finals be covering every single week?
I think so.
Okay.
All right. Okay, let's start. So questions to be considered for this week is what is the difference between business and financial risk? We'll talk about that. What is the difference between operating and financial leverage? What is the Modigliani-Miller capital structure elements theory, and what does it imply? We have done these things in last week. These are what we have done last week as well. And what is the role of taxes influencing capital structure decision? So we'll talk about tax shield. What other aspect of debt can influence capital structure decisions? Finally, we'll talk about under what circumstances will an optimal capital structure exist. So these are the 6 points we're going to talk today. So let's talk about, first you understand one thing is called break-even analysis we're going to cover today first, okay? What is break-even? Any of you want to share something with me? What is break-even? So we say when you say the word break-even in business terms, we mean that there is no profit, no loss, equilibrium situation. Okay. A firm is said to break even when sales revenue is just sufficient to cover operating cost. Okay. So you are not making any operating profit at all. When earnings before interest and taxes equal to zero, when earnings before interest and taxes are zero and EBIT is equal to zero. That's it. Assume that a firm that produces and sells only one good. These are the assumptions you're making. We're going to make some examples in here. Okay, very soon. The price of the good is P. We are developing the formula here. So the price of the good is P. Variable cost per unit VC. The variable cost is shown as BC. Fixed cost is FC. Per period are not affected by how many units. Okay, so we know this about the fixed cost and variable cost. That's what they try to say here. So fixed cost and variable cost, the difference between fixed cost and variable cost is this. Fixed cost has nothing to do with volume of production. It's fixed. Whether you produce or not, doesn't matter. It doesn't matter at all whether you produce or not. So that's what fixed cost does. The costs are fixed regardless of your production value. But variable cost is actually changes with the volume of production. Okay, so the more you produce, the higher will be total variable cost will be. So variable cost can come as per unit. Okay, variable cost will be coming as per unit. What will be your variable cost per unit? So to produce one t-shirt, for example, you need cloth. You need button, you need cloth, you need stitches. Okay, you need stickers. These things you need. So if you produce, you will need it. If you don't produce, you don't need it. Okay, exactly. For example, let's say in a cake shop, they're producing cupcakes, for example. The more cakes they will produce, the more flour they will need, sugar they will need, then icing they will need. They'll need those things. If they don't produce, they don't need it. But even they do not produce, they need to pay for the rent. The rent is the fixed cost. That's an example I'm trying to give you. You know, you guys know these things, okay? All right, next. In that situation, what will be your sales revenue? So if your price per unit is P, so how many units you sell? Let's say you're selling Q units. Okay, letting you Q is the number of units you're selling. So per unit is P multiplied by Q. So PQ is your sales revenue. And costing will be fixed cost plus the variable cost. So total fixed cost, I will say here total fixed cost. Okay, so let's say here, total fixed cost plus, look, variable cost multiplied by Q. So variable cost, so I understand, but this VC is equal to variable cost per unit. Okay, total fixed cost plus variable cost per unit, which is actually your TVC, which means total variable cost. Okay, so what will be your earning before interest and taxes? Sales revenue minus fixed cost minus variable cost. That's how you calculate your EBIT. So we say that EBIT will be equal to 0. Like we say that EBIT is equal to 0. We say that at the break-even point. So this whole figure will be equal to 0. So these things is equal to 0. Okay, EBIT will be equal to 0. So from this equation, we can come out to the solution that quantities, the break-even quantity or break-even volume, Q will be equal to fixed cost divided by price per unit minus variable cost per unit. All right, guys, is it clear? So here they try to prove it here. The solution is, the proven is in here. Okay, this is an equation you need to remember. So what is Q here? Q is Q, we should say Q for break-even point. Break-even point. Okay, how many units you need to sell to reach to your break-even point? So that's what they try to say here. Okay. Another thing I would like to add here, it's not mentioned in here, but I would like to add, which is called contribution, which is selling price per unit minus variable cost per unit. This part, this denominator part, this one is known as contribution. Okay. All right, let's go to this example. This says the XYZ company has two alternative modes of operations, A and B. Mode A, so they have two different production process. Okay, so when they produce at mode A, when they make the production at mode A, is associated with the low fixed cost of 30,000, while is mode B associated with the higher fixed cost of 80,000 per period. If they produce under mode A, their fixed cost is 30,000. If they produce under mode B, their fixed cost is 80,000. The company's product is sold at a constant price of 50 per unit. So selling price per unit is 50. For mode A operation, variable cost is 40 per unit, while for mode B, variable cost is 30 per unit. Now you have to calculate the break-even volume for sales for both mode production. What is the answer? We apply now these things we're going to apply. Let's take it to the next page. For mode A, we found, look at here, for mode A, 30,000 is your fixed cost. Per unit cost is 50. Selling price is 50 for whatever mode you produce, doesn't matter. Your sales is actually always 50. And if you use mode A, your fixed cost will be 30,000, but variable cost will be 40 per unit. Okay. So how many quantity you have to sell to reach your variable cost, to reach your break-even point? You have to sell 3,000 units to reach your break-even point. For mode B, you have to sell 4,000 units to reach your break-even point. So we have here two diagrams we have in here. So this is the way we calculate. I think I'll draw it. And I will show you guys how does it work. Okay, let me draw it. Let me draw it in here. All right, drawings in here. Okay, so this is your quantity in here. This is your price. Let me write down here. This is quantity. This is your price mentioned in here. Okay, unit. So let's this is your fixed cost. Look at the fixed cost now. Very interesting fixed cost you will see here. This is fixed cost. Okay, this is your fixed cost. Look, even you produce 0, your fixed cost is in here. Even you produce till here, fixed cost remains the same. Variable cost is in here. This is your variable cost, for example. Okay, this is your variable cost. All right. And what will be a total cost? Total cost is gonna be in here, parallel to your variable cost, but it will be starting from here. At 0 production, this is 0 point, right? At 0 production, let me write it down at 0 here. At 0 point, okay, at 0 point, look, your total cost is in here. The blue line is total cost. Let me write here. TC, total cost. Variable cost. Fixed cost. Okay, now it's gonna be clean to you guys. This is the case you have. Now let me draw total revenue is here, for example. Okay, this is 0. Yeah, total revenue. Okay, this is the case we have. So now you can see this is the total cost. See that? Total cost is in here and total revenue is in here. Slowly, it is squeezing. Look at green and blue line. They are squeezing slowly. At one stage, total cost and total revenue is intersecting each other. At this very point, at this, which one I'm gonna use? Let's say use this. That looks like a little bit red. I'm gonna use purple color.
This would be this would be the break-even point.
Yeah, this is the break-even point, exactly. Good on you. That's the break-even point. Make sense?
Yes.
All right. Let me take a snapshot. So if I need it later to use it, I can use it later. All right. Okay, so I'm gonna delete these all. Got it. That's exactly the trying to draw here. Okay, they just showed you straight. Here is your look. This is fixed cost. This is total cost. See? And this is your total revenue. So I showed you the breakup, like how to draw the why total cost starts from here. That's what I try to show you. If you have if you need to draw variable cost, it will be just exactly parallel to your operating cost, but it's starting from this point. All right, so this is the case we have. Is the diagram clear now, guys? Yeah, so break-even point is 3,000. So how much is the price? So this is price is 50. Each unit 15 to 3,000, 150 will have to be your sales revenue or cost price is in here, 150. Okay, so both the cases I think hope is clear to you guys now. When it is 4,000, again $50 sales price, 200,000 is your sales. All right, another thing I would like to add up, but it will, if I add it up, it will be too long, but I will skip it up. That's how it is, how it works, the basic mechanics, which is how does the contribution come in and why do we call it contribution, safety of margin, a lot of other stuffs are included here, but I think that's not necessary for you guys at this moment. Okay. Now, next we'll talk about risk and leverage. We're talking here. Okay. So we need this. Why we actually try to understand break-even point at this stage? Because we need to know that business needs to make their sales up to a certain stage. Business does not make every item, they do not make profit. They start to make profit after they reach the break-even. After this break 3,000 units, every unit they sell, they will make a profit. How much profit they will make? They will make profit of 50 minus 40, 10. This much profit they will make. So what is this? What is this thing? This 3,000 units they mean? It means till 3,000 units, they cover fixed cost plus variable cost both. So at 3,000 units, your fixed cost will be fully covered. Okay. Look, your sales price is 50, right? And your fixed, your variable cost is 40. So every unit you sell, you are making $10. But this $10 is not your profit. Why? Because you have $30,000 of fixed cost. Make sense? So every item you sell, you're making $10 towards fixed cost, fixed cost, fixed cost. Every item you make, $10 fixed cost, $10 fixed cost, $10 fixed cost, like this. When you pay 10, 10, 10 like this till 30,000 is reached, your fixed cost is covered. How much money you need? How much unit you need to sell for that? 3,000 units you need to sell to cover your fixed cost. After 3,000 units, 3,001 unit, that $1 you make, one unit you're selling, making $10, that $10 is your profit. Okay, then only you receive the profit part. That's why it's important to understand that business doesn't make, business needs to sell a certain number of goods to reach, to cover their cost, and later they make the profit. Okay, so now business risk and operating leverage. What is business risk? Business risk is the risk to the firm of being unable to cover its operating cost. That's business risk. When business cannot cover its operating cost, here it is operating cost. See that? When business covers its operating cost, there is business risk. Let's say this business could not sell 3,000 units or 4,000, they could not sell that much units. Business has some risk, they couldn't cover the operating cost. Okay? All right. Now, let's talk about business risk and financial risk. Financial risk is the risk that when the business cannot pay its interest, leasing fee, interest fee, when business is unable to make those payments, that will be known as your financial risk. All right. Next. A firm's business risk can be measured by the, okay, we've done that. This business risk is the risk inherent in the firm's operation. If a Farms, okay, we know this now. Operating leverage. What is operating leverage? The potential use of fixed operating cost to magnify the effect of changes in sales on the firm's EBIT. What this says? The potential use of fixed operating cost to magnify the effect of changes in sales on the firm's EBIT. So it means this way, let's say this way, that when the business has their fixed operating cost, the sales will be high. If there is a high degree of operating leverage, a firm will face a high degree of business risk. In so far as there is variability of sales. Sales will vary. Sales is never always fixed. Sales varies. Its sales depends on market, depends on competition, business and economic situation of the country, depends on COVID-19 pandemic too. All right, so business depends on numerous factors, including output, demand variability, sales price variability. Important factor is the degree of operating leverage. For the operating leverage, the potential of using fixed operating cost to magnify the effect of changes in sales on the firm's EBIT. Thus, if the demand for firm's output falls, the firm will still have to pay its fixed cost, and there will be a relatively large fall in EBIT. The demand goes down, yeah, business will be in problem. That's the operating leverage. Okay, you will have a good leverage if your fixed cost is low. Okay, for the same example we have in here. Okay, to show the influence of operating leverage on earnings per share, we will also assume in this stage that XYZ is 100% equity financed with 1,000 ordinary shares, no preference share is issued, and that the firm pays tax at a rate of 30% on its earnings. So there are some more information added in here. Now we have given you an example in here. And we'll show you that how a higher fixed cost is going to have impact on the EBIT. Okay, have a look. Let me make it a little bit bigger. The following table shows calculations of EBIT and EPS. EPS means earning per share for sales level of 3,000, 4,000, 5,000, 6,000, 7,000 units. Okay. 3, 4, 5, 6, 7,000 units selling. And you know that unit price is $50. That's our sales revenue in here. Mode of operation A, mode of operation B. For mode of operation A, our fixed cost is 30,000, variable cost is 40. For mode B, mode of operation B, fixed cost is 80,000 and variable cost is 30. Operating cost is mentioned here. This is operating cost. 50,000, 90,000. Okay, how do we know 150,000 operating cost? I'll show you one example. I'll show you here. Operating cost will be fixed cost plus variable cost. How many units you are selling? 3,000 units you are selling, right? So 3,000 multiplied by 40, 120 plus your fixed cost, 30,000. That's how you get 150. 190, same way. 4,000 units multiplied by 40, 160,000 plus 30,000 fixed cost, 190. That's the way you calculated your operating cost. So sales revenue minus operating cost, you get the EBIT, earning before interest and taxes. Now you pay 30% tax. Okay, so minus tax 30%. How much is left? Earnings after taxes. So here you have no earnings, zero earning, tax will be 0. Earning per share is 0. Then earning after tax will be 7,000 because 30% is going to the tax. 20 is your earning before interest and taxes, 30% goes to the tax, 14,000. So you understand this one. This 7,000 is your earning after tax. It should be divided by your ordinary number of shares. How many number of shares you have? We have 1,000 ordinary shares. 7,000 divided by 1,000, $7. See? So it means here, your fixed cost is 30,000. The more you sell, the better earning per share you will have. Now let's go to the other case in here. Okay. In this situation, again, you're selling 3,000. If you sell 3,000 units, your fixed cost is high here. How much is your fixed cost here? 80,000, not 30,000 in mode B. Okay. So operating cost is 170, whereas it was 150 before. 190, 200, 230, 230. You see that? I'm sorry. So in this case, we can see the same rule applies, and we can see here earning per share is, if you sell 3,000 units with a higher fixed cost, your earning per share is negative. Okay. So you see that another thing you can see, interesting part you can see here. If you have a higher sales, you see that higher fixed cost and lower variable cost. Look, variable cost was 40 in mode A, but 30 in mode B. If you have a higher fixed cost, after you cover the fixed cost, which is here, break-even point. When you cover your fixed cost, then the profit you make, look, if you can sell higher sales, will give you higher earning per share. So higher fixed cost, not necessarily all the time is bad. If you can make a good sell, it will give you a higher return. So the reason is not necessarily all the time is about the fixed cost. I would say the reason is actually for the lower variable cost. Okay. All right. So that was the thing we wanted to show you. So now, how do you calculate degree of operating leverage? This is the formula you're going to apply. Okay. That's the formula. Percentage change in EBIT. Oh, gosh. Give me a minute. Okay. And I would like to make all things else. Yeah, better now. Percentage change in EBIT divided by percentage change in sales. That's how you calculate your degree of operating leverage. Okay. All right. Let's go to next one. Okay. Alternative formula for DOL at some base level of Q is given by, so this is the way you calculate. Okay. Quantity into P minus VC, which is contribution into quantity, divided by Q into P minus VC minus X. So yeah, so this is another formula you actually working on. All right. How about DOL will change with the base level of sales considered? Okay. So consider again another issue we're considering in here. Okay, the DOL is changing in here. DOL means degree of operating leverage. Consider again in XYZ company example, calculate the degree of operating leverage at the base level sales of 3,000, 4,000, 5,000, 6,000, 7,000 units for most A and B operation. So we're calculating here EBIT and DOL, calculating in here. So DOL for different 4, 2.5 to 1.7 is actually decreasing slowly. Degree of operating leverage is decreasing. When you have a higher sales, the degree of operating leverage will be decreasing. Okay, so it's changing in here. For example, at a level of sales 5,000 units, in this case, okay. So EBIT is same. Look, EBIT 20,000, but degree of operating leverage is double actually in here. Okay, This is the same result as we get by considering a change from 5,000, 6,000 units sold. Okay, so 2.5, and there it is, actually 5. Now let's talk about financial risk and financial leverage. Okay. Okay. So what is financial risk? Financial risk is the risk to a firm being unable to cover its financial obligations like interest, lease payment, preferred share dividend, these things. You cannot pay the financial obligations. That time we call it financial risk. Okay. So business will have operating risk, business risk, and also they will have the financial risk. Alternatively, financial risk is the additional risk borne by the ordinary shareholders resulting from the use of debt to finance some of the firm's assets. So now we have an equation for that, DFL, degree of financial leverage. Okay. All right, and this is the formula: percentage change in earning per share divided by percentage change in EBIT. And here you see that percentage in EBIT divided by percentage change in sales. Okay. All right. So here another way you can do that. EBIT divided by EBIT minus interest expenses. All right, now let's move on to this example. Suppose that in our XYZ company, same example we are using, everything is unchanged except that the firm's asset with an assumed value of 200,000 are finally 50% debt and 50% ordinary share. So before it was all about all the money was raised by share capital, ordinary share capital. Now we said that now let's change it. Let's say 50% is on. 50% of the capital is raised by share and 50% is raised by the debt. Okay. So this is the case we have. Let me take it to the next page. It will be better. More the operation for cost, the cost of the 8% interest rate. So the debt they have like 50% debt, 50% equity share. See that? 50% debt and 50% equity finance. So 500 ordinary shares on issue. Rest of the money came from the debt, maybe loan from the bank. And the interest rate will be there, 8%. Now we have earning before interest and taxes. The same, we're going to do exactly the same way. Earning before interest and taxes is this, like 3, 4, 5, 6, 7,000 units of sales. Operating cost is the remain the same thing. Earning before interest and taxes is 0 for mode A. This is the earning before interest and tax. Then you pay the interest, 8%, 8% of interest you're paying. Okay, 8,000 is the interest rate. So earning before interest and taxes is this. Company tax is this much. Earning after tax is this. Okay. Earning per share. So now 5,600, it will be divided by now 500, not 1,000. Okay. Degree of financial leverage is calculated. For example, at the base earning before interest and tax level is $10,000. This one. Okay. Our degree of financial leverage will be 5. Okay. By the other formula, any formula used, it comes out of 5 is the answer is coming out. Okay, now let's talk about total leverage. Okay, degree of total leverage. So degree of total leverage can be defined as what? As the potential use of fixed cost, both operating and financial, to magnify the effect of changes in sales for a firm. EPS. So now you're saying that degree of total leverage, the percentage change in EPS divided by percentage change in sales revenue. Anyway, they've given another example in here and to calculate these things. I would like to jump on to capital structure too. Then we'll cover another chapter. We're going to cover mergers and acquisitions. So I will go a little bit quick now. All right, describing capital structure. So capital structure generally refers to the mix of debt and equity used to finance a firm's asset. Capital structure means how your capital is structured, how you money, how did you capitalize, how did you get the money, how the business was financed. Okay, business, project, asset, how it was financed. Okay, so what percentage has been done through issuing asset and what percentage has been done through taking loan or debt. So it's two things we have, equity and debt. Okay, debt means you're taking a loan from the bank, and equity means you're issuing shares. All right, debt ratio will be equal to total liabilities by total assets. So the firm's like two summary measures are commonly used to include a firm's capital structure: debt ratio and the debt to equity ratio, two things. So debt ratio formula is this one, and debt to equity ratio formula is this one. Okay, debt ratio means total liabilities by total assets, and here debt to equity means long-term debt divided by equity. Different formulas. Both these ratios are directly and positively related to the differential leverage. So now let's move on to the Miller and Modigliani capital structure elements theory. So what did he say? Miller and Modigliani, like last week we talked about this one. He said that dividend has no relative. It doesn't need to any has no relation with the firm's value. Why? Because share price will increase. So it doesn't matter if you pay dividend or not. Dividend is irrelevant. That's what he said. Miller and Modigliani, that's what he said. Okay. We had some issues with his theory because it does not have transaction cost, tax was been there, so he didn't consider those things in his theory. Okay, that's why we've been criticizing that theory in the last week. If you guys remember that, let me see. This one. Let me remind you this Modigliani theory so you guys can remember this. I think this one. Miller and Modigliani, dividend policy is irrelevant. Remember that one? Last week we discussed this thing. Miller and Modigliani, dividend irrelevance theory. Okay, what did he say? Dividend and capital gains are equivalent when the investor considers return on investment. So that the value of company depends on its earnings only, not to the dividend policy. He says that the value of company depends on the earnings only, not the dividend policy. If the company performs well, the share price will increase. And the investors are capable enough to make their own cash flows from the stocks selling their stocks. So we don't need to pay them any dividend. The share price is increasing, that's it. Company's profit is increasing, company earnings is increasing, so your earning per share will be increasing. And share price will rise. If you need money, sell your share. Why need to worry about dividends? That's what is his point. But we also criticized him, like what the criticism in here, that he's thinking a capital market is perfect. There is, according to his theory, there is no taxes paid. That's what he was thinking. But it's not. So his assumptions was wrong. He criticized his assumptions as well. So that's okay. All right, that's what we want to do. So here, the same thing you're gonna do. He said, by maximizing the firm's value, the wealth of shareholders will also be maximized. That's what is his point. Okay. All right. So we also don't expect that you're going to accept these things. You're going to criticize him. We know that. So yes. So his assumption was that a perfect capital market exists. That's what he thinks, but it's not true. Capital market is not perfect. When you say capital market is perfect, do you know how does he mean? He means that the price of the share we have, let's say today's share of West Farmers share is, let's say, $30. For example, I think it's 35 or 40 maybe now. It's a $30 now share price. He thinks this is the perfect price. This price is the right price. But you and me, we know this share might be overstated, might be understated. We need to check whether this price is correct or not, whether this price is really reflecting the proper value of the business or not. That's why we have financial analysts to do that job. But Modigliani and Miller, he thinks these two persons, yeah, they think that capital market is perfect. Share price is not understated, not overstated. And he also thinks there is no taxes, but no. If you make money from share market, you have to pay taxes. Okay. And he thinks companies and individuals can borrow at the same rate of interest. This is also not correct. Company share and individual share rate is interest rate is not correct. It's not same. There is some distance, and we also made some criticism about that as well. So the three implications of MM is Modigliani and Miller analysis are: the work of firms, weighted average cost of capital of a firm is independent of its capital structure. Regardless of level of debt financing, weighted average cost of capital of a firm equals its cost of equity under zero debt financing. So the other three implications they have found out. Now we'll talk about taxes and capital structure relevance theory, which is in here. I'll show you. So this was his irrelevance theory. Okay, Miller and Modigliani. But then we talked about another one we talked is called relevance theory. Yeah, dividend relevance theory. Okay. So the dividend relevance result will not hold if any of the special assumptions are not satisfied. Two major possibilities are: investors as a whole are not indifferent within dividends and capital gains. Investors, okay, are not indifferent. Yeah, it means that I'm not saying. So capital gain and dividend is not the same thing. Okay. There may be capital market imperfections. In particular, there are usually taxes. Yes, it is true. In capital relevance theory, they mean that the first thing they talk about, the bird in the hand argument. Whatever I have at this moment, currently I have, take it, pocket it first. Okay, so bird I have in my hand, put it in my bag first. The dividend is offered to me, take it. I'm not going to wait for share price increase or decrease. I have been offered some dividend, I'll take it. Make sense? Just grab it. That's what the bird in the hand argument comes up. Okay. And second point is a preference for retained earnings under the classical tax system. That's the trick that the tax system. Tax is also involved in here, so we're going to actually see here about our tax issues. So we here try to relationship that we develop here is dividend payout ratio and the cost of equity ratio. Okay, we said two things: bird in the hand is negatively related, but tax preference is positively related with the dividend payout ratio and cost of equity. If the dividend payout ratio increases, cost of equity also will increase. All right, let's move on to these ones. Effect of corporate tax on capital structure is irrelevant. No, this one is Modigliani, right? Tax and capital structure. So tax and capital structure is related. The effect of corporate tax on capital structure, classical taxes is irrelevant. How it is work? Let's see. Under the classical tax system, company profit are taxed twice. Once the company level, and again when they are paid out as dividend. But your franking credit system now, okay. In the context of the original Modigliani-Miller assumptions, if we introduce company taxation only at a structure rate of T, tax rate, and assume the firm's level of debt D and before tax cost of debt RD are constant in perpetuity, constant forever. Tax rate doesn't change. Okay, these are the criticisms. Okay, the original Miller-Modigliani results that the firm value is not affected by capital structure change to this. Original theory was that, but it's not true. Real life is not right. So this says here value of BL, value of financial leverage firm, will be equal to value of all equity financed firm plus tax and debt. Okay. Tax rate and the level of debt. So it means how much tax you are saving. Tax rate. Okay. I think I should move on to these things. They have the formula is in here. How did they get this formula? So derivation is pointed out in here. The effect of personal tax. So this is corporation tax. Now look at the personal tax. In personal tax, so Miller argued that existence of personal tax would generally remove any advantage of debt financing over equity financing in the classical tax system. So Miller noted that the creditors of a company must pay personal taxes on current interest income. Whilst, okay, shareholders can usually defer tax on capital gains, resulting in the latter enjoying lower personal taxes. Purchasers of debt would react to this by demanding a higher interest rate, thus reducing the advantage of debt financing. So look, these things is actually not in real life. It doesn't work like that. In real life, we have our capital imputation tax system. In real life, we have a franking credit system as well. If the company has already paid the taxes, okay. So the point, but at one stage they're right. But when you pay the taxes for the corporation tax, you pay 30% corporation tax you have paid. Okay. So let's say the company earned $2 million and $500,000 has been given to the shareholders. On this money, that business is paying tax 30%, and again, when the money is going to the shareholders, they're paying again income tax as a dividend income. Okay. Now here they're talking dividend imputation tax system. Yeah, dividend imputation and capital structure. Under the dividend imputation tax, all shareholders can use all tax credit. Company earnings are effectively only taxed once. That's what I was trying to say, that we have tax imputation credit system, and also we have franking credit system, frank dividend credit system as well. So if the company already paid the dividend, you can, as a shareholder, you can claim that tax back. Okay. All right. Non-tax reasons for capital structure relevance. What about other things, not the tax or other taxes? So other things, we have financial distress. So financial risk arises when a firm borrows, even if the debt is riskless, in the sense that there is no risk of default. Still, there will be some risk. Debt is said to be risky when there is some low risk of default. There is a low risk of default, it's not that much. Agency cost. Agency cost is like the managers are taking advantage of the business. Agency cost arises from the potential for conflict of interest between shareholders, creditors, and managers of a firm. When there is a conflict between the managers and the shareholders, that's called agency cost. Why they call it agency? I'll give you a little bit. I'll talk about it, not much. Because shareholders are the people who will not participate in management. Let's say you are a shareholder of Microsoft or Apple computers. You do not have right, or you are not going to check how much they sell. It's Tim Cooks and other people who are management in there. Those are the people who does all those cooking. So you don't know these things. How much they sold, how much profit they made, where the money to invest, where not to invest. They make all the decisions. But you as a shareholder, you hope that, I think before I say this line, I should say another line in here. They're making all these decisions about the business, they're enjoying the profit and everything is there, they're taking the salary, everything is there, but you are the shareholder. You are the person who is paying, who has invested the money. You are the one whose money they are playing with. So the relationship between shareholder and manager is agency relationship. That these managers are actually been given the power to take the money from you and use it at the best interest of the business. Not for them. Best interest of the business, and as a result, end of the day, it will be the best for the shareholders. So you are using them, you are actually you are using these managers as your agent. That's why they call it agency relationship. Okay? So that's the relationship between managers and the shareholders. But there is always conflict. What is the conflict? Here is the conflict. Claim dilution, dividend payout, asset substitution, under investment. Here are the conflicts they have. Okay. So now let's have a look in here. Claim dilution. Okay. Okay. These things are like they borrow more and more money. Okay. Dividend payout. Managers don't want to pay dividends, but shareholders always want to have some dividend. Asset substitutions. So manager always wants to substitute the assets, but shareholders they don't. Under investment. Shareholders want the managers to take risk and make a bet, make more and more investment. But the managers don't want to make investment until they're very sure. But these are the conflicts they have. Now the question comes up: what is optimum capital structure level? So now, so far the assumptions of the capital structure, Modigliani and Miller capital structure results do not hold in reality. It's not hold. I told you that it's not realistic. We can conceive of being an optimal capital structure for the firm. How do we do that? We say, for example, if EBIT is constant and all after-tax profits are paid out as dividend, we have general results that the value of the firm will be this. Okay. Value of the firm can be calculated as this. Value will be equal to EBIT into 1 minus T divided by RD. Okay. So this is your. So how did you get this equation? So they try to show you how do they derive this equation. Okay, so there is a relationship in here, debt ratio, and here is the capital cost of capital, and here another one is debt ratio and farm value. Did they give something now? The relationship we try to show here, the debt ratio and capital structure have a positive relationship here. Okay, and what is that? The RD, rate of interest, it will be going down at one stage, going down slowly, but at one stage it will be increasing slowly. When the rate of interest goes down, the relationship is that value of the firm increases. Look at here. So if it goes down this way, value of the firm increases. When rate of interest increases again, value of the firm drops. So the optimum structure where the value of the firm is highest. All right. All right. Now, next topic, we're going to talk about merger and acquisition. And okay, let's see. We'll cover only this much. This things will not be covered. We'll cover only this much. Only this much will be. So we're going to cover only till third one. What are the main reasons of mergers? For the leverage buyout and debentures, that much will cover. Not these two only will cover. So these are the basic terminologies: corporate restructuring, acquisition and takeover. What is corporate restructuring? The general term used to describe changes in the level of a firm operations or the structure of this asset financing. The general term used. So when we use the term corporate restructure, we mean the general term used to describe changes in the level of firm operations or structure of its assets or financing. The corporate restructuring. Okay. So structure of the assets and financing, it means that how they are restructuring their debt ratio and other things. That's what we're going to talk in here. Acquisition or takeover, one company will take over another company. That's it. Merger, two companies will be coming together to build another new company. bringing two or more independent companies together under one single control. Okay. Consolidation means the combination of two or more companies to form a new company. That's called consolidation. Acquiring company means the firm attempting to acquire another company. Target company who will be acquired. The firm that is the object of a takeover attempt. Friendly merger. Mutually they come and merge each other. Hostile merger. They're hostile to each other. They take over, boom, I'm taking you, buying you out. That is resisted by the management of a target firm. A strategic merger, technically, tricky way they will take over. Strategic merger. They merger motivated by desire to benefit from economic of scale. Strategic merger. Financial merger. The merger motivated by a desire to reconstruct the target firm's cash flow in order to achieve improved financial performance. Okay, why do people merge? Okay, the reasons are this: fundraising abilities. Two companies coming together, they can actually make it bigger so that they can raise more fund. Okay, let's say one company has 10 million, another company has 2 million. Combined together, they have 12 million. Okay. Another one is management skill and technologies. So the more people involved, the more management skills will be there, because the one person cannot be expert in every sector. So yeah. Greater liquidity, they will have more cash money, more liquid money they will have. These are the tax benefits as well. Okay, tax benefits also important. Tax benefits due to tax loss carry forwarded. Okay. So like, I think you guys know these things. Like if a business have a loss this year, okay, next years they can actually make, next year they can actually make loss, they claim the losses. Let's say they made a loss of $10,000 this year. Next year they made $5,000 profit. They will have to pay taxes because last year's profit needs to be covered. So that's what they will talk in here. And what else we have? Non-merger firms in dollar and after margin. They try to show you here that how do they make the tax benefit out of margin. So earnings before taxes is this much, tax is 30% tax. So they make $80,000 and they're paying taxes of this much. So earning after taxes is every year. But when they merge, earning before tax is 80. Tax loss carry forward. The taxes are there. Tax losses. Another company is making a loss. That's why your margin. Okay, they can actually make a profit out of it. Okay. Another company is made loss. Okay, that's what they try to say. Another company made a loss. So bring that company in your business, and you can claim those losses. And what are the different types of margin? Two types of margin: horizontal margin and vertical margin. Horizontal margin is that two same level of business will take over each other. Combine each other. Take over is acquisition. Merger means coming together. Okay. Like you guys see these things, like even on the street, you see two-lane merge coming together, right? Two lane is coming together. Like this. That's horizontal. A merger that involves two firms operating in the same line. They are horizontal. Vertical margin. Vertical merger means that a merger that involves two firms operating at a different stage in production process. One is, let's say, producer, another one is, let's say, retailer. So producer taking over retailer. Retailer is merging with the producer. Then congeneric merger, a merger that involves two firms in the same general industry but operating in different line of business. They are not competitor to each other, but they're merging for some future. They have a future together. Okay. Conglomerate merger, a merger that involves firms is unrelated industries. When two companies merges for some other reasons without having any common business. Completely different, the merging together. All right. Okay. Leveraged buyout and divestitures. What do you mean by this thing? Let's have a look. A leveraged buyout occurs when a small group of investors acquires a firm by using a high proportion of debt financing. Leveraged buyout. It is a type of financing merger, financial merger. This type of corporate restructuring normally involves a publicly owned firm being transferred to private owners. So some people, group of people will come together, and they will take over one public company. That's what normally happens. Okay. Due to the significant use of debt financing, a candidate firm for a leveraged buyout will normally be characterized by good growth prospect, low debt, and stable cash flows. Okay. And divestiture involves of sell off of some firms' assets for cash. Not invest, divest. Okay. Very simple. That's all we got here. So for analyzing mergers. So what is the fundamental relationship of these things? This is here. Value of merged firms will be equal to value of acquiring firm operating independently plus value of target firm operating independently plus value of synergy. What do you mean by synergy? Okay. How do you mean by synergies? Synergies are this, like when two firms comes together, they will have some extra power in there. They will have some extra strength they will receive out of this. That will be the synergy things will be coming into. Okay. So, and the next one is value of target firm operating independently plus value of synergies. So value of merging firm, value of acquiring firm. Okay, let me show you here the difference between these two. Okay, so when you talk about value of acquiring firms, value of acquiring firms operating independently. Okay, value operating independently. So that time that will be added with value of target firm operating independently. Let's say you have one firm, firm A. You want to merge with firm B. So your operating, your value and the firm B's value, both of them will be coming together. Plus, since you two are working together now, okay, when you combined together, okay, now this combination will have more interactions. Those will be added up to. When you've been working independently, you did not have some special things coming up here. When you're both coming together, now you're working both together with more motivations and more strategies. That will be added, need to be added to. That's what they mean the value of synergies. There is a combined effect will be added to, value of combined effect will be added to, you can say that. Now, the value of target firm, so value of merged firm is this one. Okay, when you merge together, it becomes merged firm. Value of target firm to acquiring firm, value of target operating firm plus value of synergy. That's what you see when you as a value A, a firm A, you are thinking I'm going to take over firm B, but that time, what is the value of firm B to you when you consider that one? That time you will be thinking, what this new firm, what this firm B has, plus what else I will receive after I combine together. That's what they mean. And net present value of acquisition, value of target firm, okay, value of target firm, net present value of acquisition minus value of target firm to acquiring firm minus cost of acquisition initially outlays. Okay. All right, I think I'll stop it in here. These things are actually also there about this part and beyond will not be included in the final exam. If we have time, we can go through these things, but I think I'll stop here because I have only half an hour more to go. So I don't have these things at this moment. I'll take you guys to the questions now. We're going to cover here some questions we have in here. So we'll talk about these things now. Before I go ahead with these things, may I ask you guys, do you guys have any questions for me, please? Any questions for me, guys?
I don't have any questions personally.
No worries. Thank you very much. If
Yeah.
someone has, I think they will talk. If they don't, I'll assume nothing. First question is, does following the residual theory of dividend lead to a stable dividend? Is this approach consistent with the dividend relevance? Today, I think mostly we have all theoretical questions, right? Oh, no, we have one problem questions, problem solving one questions. We'll do that one. Everything. All right, let me see how many problem solving questions do we have. Okay, so 1, 2, 4, 5, 6. Oh, we have actually. Oh, okay, we have problem solving questions. So we have just a couple of theory questions first. All right, let's do these things. Then mostly our problem solving questions there. Thus, following the residual theory of dividend lead to a stable dividend. What the first we have to understand, what is residual theory of dividend? The residual theory of dividend suggests that the firm's dividend payment should be the amount leftover amount. What is leftover? That is after making all the investment, if any money is left, that will be given to the dividend holders. Nothing much will be given to them. Will be giving them only what is left over. Okay. Yeah. So that can dividend. Yeah. Shareholders are treated like two or distant cousins. All right. Contrast the. So now the question. The question is this lead to a stable dividend? Does it? It is not. Because, you know why? Because dividend, like investment opportunities changes every time. If you see that your managers are not giving any dividend, next year you are the one who has the money, and you are the one who invested into the business. If they do not treat you right, if they do not give you the money you deserve, you're not going to keep your money within this company. You're going to take the money away. Right? Is this approach consistent with the dividend relevance? No. Dividend relevance, dividend irrelevance will be consistent here because they think that dividend policy is completely irrelevant. In this one, like residual theory of dividend, it also has the same attitude. They don't pay any dividend, whatever leftover, give it to them only. And dividend irrelevance policy also, like Miller-Modigliani theory also says the same way. The dividend is not important. Contrast the basic arguments about dividend policy advanced by Miller-Modigliani and by Gordon and Lindner. Okay. So we know this one. We know this one very well. The basic arguments about dividend policy by Miller-Modigliani. Miller-Modigliani says that dividend policy is irrelevant because the share price will increase. If the shareholders need money, they can actually sell their share and get the cash. Why business need to give them any dividend at all? Okay, that's what he says. And Gordon and Lindner, okay, dividend. This is look, Gordon and Lindner. This is dividend relevance theory. Okay, they says that there is a direct relationship between the firm's dividend policy and the market value. Their point is dividend is very important, but Miller-Modigliani, he says, no, it's not important. Okay, that's the difference. So according to his bird in hand theory, okay, theory says investors are generally risk averse. So whenever they get the money, they just grab it. So dividend is important for them. Okay. Next. How does the imputation system of dividend payment remove the double taxation dividends? Oh, you can get the tax money back. In this case, like it is called a tax imputation credit. Tax imputation credit, we call that one. Imputation system of dividend payment. They say that taxpayers will be given a credit. Taxpayers will be given a credit. Sorry, shareholders will be given a credit for the tax paid on the dividend. That's the way they actually remove the double taxation. Okay. On Monday, 3rd of June 2013, directors of Abco Proprietary Limited declared a dividend of 150 per share to be paid on Wednesday. Oh, okay. The date things, remember? Declaration date and all those dates. We're going to talk about those dates now. Okay. Declaration of dividend. Then after declaration, okay, the dividend payout, dividend payment date, those things we'll be discussing here now. Let's see what information they have here so far. Ex-dividend date, remember these things? That thing will be coming up. On Monday, 3rd June 2013, the directors of Abco Proprietary Limited declared a dividend of 150 per share to be paid on Wednesday 17. So 13 and 7. Oh, 3rd of June, okay. 7th of July, which the date of record of Tuesday, 25th of June 2013. So we have date of record, we have the dividend declaration date. Okay, we have this. Just before the date of declaration of the dividend, the firm have 20,000 shares on issue. A cash balance of 200,000 retained earnings of 350,000 and no dividends payable. Determine the ex-dividend date and show account values for cash, dividends payable, and retained earnings at the following 3 points of the time. Just before declaration of the dividend, just after declaration of dividend, just after payment dividend of the payment. So 3, just declaration of the dividend, just before the declaration, and just after. This 3. All right, let's do it. Let's do it. All right. Let's say here, cash will be how much? 200,000 debited. The other side, dividends payable. Okay. And next one, so this is the situation just before the declaration of the dividend. Okay, everything dividends payable is 0, and this was much what the cash was in the business. Okay, 200,000 cash was in the business, and how much was retained earnings? 350. Retained earnings was This was the case. Okay, just before declaration of the dividend. Then what happened? Just after the declaration of the dividend. Okay. After the declaration, now we have dividend. How much dividend we have to pay? shares on issues. So 20,000 shares on issue, and each share will be given 150, 30,000. Okay. 30,000 dividends. Just after the declaration of the dividend. There's a responsibility now. They have before declaration, they are zero dividend. Now, just after declaration, dividend payable is this. After the payment of the dividend, now what's going to happen? Now your cash will be reduced, your dividend payment will be also gone. Okay. Just after these things, very simple. Now what happens after that? Out of 200,000 to 179. So 30,000 is paid. Now, since you paid, do you have any more dividend payables? No. Okay. And retained earnings, it will not be 350 anymore. 30,000. Okay. That's it. A farm has 800,000 in a paid-in capital, retained earnings of 40,000, including the current year earnings of 25,000 ordinary shares. In the current year, it has 29,000 of earnings available for the ordinary shareholders. What is the most of the farm can pay in cash dividend to each ordinary shareholders? Assume that legal capital includes all paid-up capital. What effect would a cash dividend of 0.8080 cents per share have on the farm's balance sheet entries? If the farm cannot raise any new funds from the external sources, what do you consider to be the key constraint with respect to the magnitude of the farm's dividend? Wow. Okay. All right. Okay, now. First thing is about how much maximum dividend can be paid. So maximum dividend will be how much? $80,000 paid up capital, retained earnings 40,000. So 40,000 divided by 40,000 this. Okay. How many shares? They have 25,000 ordinary shares. Even they give all the profit to the shareholders, how much it will be? So 40 by 25, it will be 1.60. That much they can give maximum dividend per share. per ordinary share. Second is, what effect would a cash dividend of 80 per share have on the firm's balance sheet entries? Oh, if they give only 80 cents, so they are only using $20,000, and 20,000 will be increased in their retained earnings, right? So yes, so 20,000 will be there, retained earnings that will be gone down. Like look at here, when they paid 30,000 dividend, the dividend is reduced by 30,000, cash reduced by 30,000. Same way here. If they pay 80 cents, they said, okay, we are not going to pay. We can pay maximum 160. You can pay. If we pay 160 per $1.60 per share, all our 40,000 income will be gone. Retained earnings 40,000 will be gone. We just want to give them 80 cents per share. It means 50%. So 20,000 will be reduced. Okay. Number C. Battery is going down. Give me a second. If the firm cannot raise any new fund from external sources, what do you consider to be key constraint with respect to the magnitude of the firm's dividend payments, and why? Of course, cash will be the key constraint, right? Because the firm cannot pay out more dividend that it has in cash unless it borrows. Okay. The cash will be the only problem. Nancy Lau currently holds 10,000 shares in a Icicle company that supplies air conditioning system. Icicle has issued a total of 250,000 ordinary shares, and no preference shares are issued. The firm most recently had earnings available for ordinary shareholders of 750,000, and its ordinary shares have been selling for this much share. The firm intends to retain these earnings and pay a 10% per share. All right. The firm, okay, now, what is the firm's current earnings per share? Good question. What proportion of the firm does Nancy Lau currently owns? Let's do it. Current earnings per share. How do you calculate earnings per share? Each share, the firms most recently had earnings available to ordinary shareholders 750,000. This much money they are going to distribute. And how many shareholders they have? 250,000 shares. So 750,000 divided by 250,000. So EPS is equal to 750,000 divided by 250, which is equal to $2. Right? What proportion of firm does Nancy Lau currently owns? Very easy. So how many shares she has? 10,000 shares she has. Right? The company has 250,000 ordinary shares in the market. Right? You can say, let me copy this video. Percent should be equal to, she has 10,000, right? Out of 250,000 shares issued by the company, share only 10,000, it should be multiplied by 100 now. Will be equal to 0.04. 0.4%. 4%. 4%. Okay. What proportion of the firm will Nancy Lau own after the share dividend? Okay. All right. After the share dividend, is it anyway? So look, it doesn't matter. It doesn't matter actually. It will remain the same. It doesn't matter. It will actually remain the same way. It's not going to change anything. That's the whole point. At what market price would you expect the firm's ordinary share to sell after the share dividend? Okay, the share dividend. How much the share dividend was given? The ordinary share has been selling for 34.10 per share. And the fund intends to retain these earnings and have a 10% share dividend in here. All right. So the 34.10 per share, that's what they had at this stage. You can say expected new. This is not E at all. You can say expected new. Yes. Okay. Will be equal to 4.10 divided by 10. We have a 10% increase. So reduce it by 10%. Actually, I should show you guys this thing. 3.10. That's what it should be. So if you All right. Next. So, suppose an individual subject to 30% marginal tax. This is franking one, right? Franking rate. This is very important. Okay. Suppose an individual subject to 30% marginal rate of income tax has 2,500 shares in the company that is paying a partially franked dividend of 40% per share. With a franking ratio of 0.70, 70%, individual is resident for taxation purpose. If the company tax is 30%, what tax credit can individual claim due to the partially franked dividend? So first we need to identify how much is the total tax that individual has paid. Okay. After that, we'll have to calculate how much is supposed to be paid, and then we say how much is already been paid. So that's the way we talk about it. Okay. All right. Now let's do it. So total, how much is the total cash dividend, it will be equal to something 40%, 40 cents per share. $0.40 per share. So 0.40 multiplied by 2,500 shares will be equal to 40% of 2,000 is 1,000. 1,000. Total cash dividend is 1,000. Now, let's talk about tax credit. Okay. Now, tax credit will be equal to dividend. Multiplied by tax rate divided by okay. All right, into multiplied by franking ratio. The franking ratio. All right, so let's do it. Tax credit, how much is that? Dividend, 1,000 multiplied by tax rate is 30% divided by 1 minus tax rate, 30%. How much frank? 70% frank. So this will be 0.70. Okay. Equal to $300. Okay. That much is tax credit she got. Now we're going to see that how much was the question is the tax credit dividend. That's what will be. What is the tax on the taxable income? Now we're going to check that. What is the tax on taxable income? Okay. You say here tax on taxable income. Okay. How much? It will be 0.2, 30% multiplied by 1,000 plus will be equal to for the tax and taxable income. How much tax has been paid? 300 has been paid. So this person need to pay another $90 to the tax payable. Yeah, so tax payable 90%. How much tax needs to? What tax, if any, is payable by the individual out of the cash dividend payment received? You have to pay $90. How do we know? 390 minus 300. Let's see here. Tax payable. So that dividend income would be 390 minus 200 equal to 90. Okay. Last question here. Suppose a company pays out fully franked dividend of $70 each to investors with marginal tax of 19%. The statutory company tax rate is 30%. How much tax will each investor pay on his or her franked dividend? Okay, we'll do the same thing here. Here we choose. Okay. We'll say imputation credit for each investors. Sorry. Imputation tax credit for each investor will be equal to dividend into TR divided by 1. It will be equal to, so how much is your dividend here? 70. Dividend is 70. Tax rate is actually here 30%, so it's 0.0 divided by here. Answer will be equal to. Okay. All right. Now, so we can say here for the total dividend, for the dividend will be equal to 30 plus 70 equal to 30. I can say 70 plus 30, that would be nicer. 70 plus 30. So it means $100 is the total dividend that person received, and 30% has been 30% tax has been already been paid. Now we have to see out of $100 that person marginal tax income is 19%. So we can say here gross tax on, it's a gross tax on gross stock dividend income. You can say here tax payable and gross tax is equal to 0.19, 19% multiplied by, I'll do that just again. To the equation here, 19 multiplied by 19 dollars. Okay. hold on. So tax payable actually $19. How much tax has been paid? $30 tax has been paid. Okay, so you can say net tax payable. Okay. And dividend income is equal to 19 minus 30 is equal to minus 11. It means this person will get a tax refund. All right, that's it. That's all we have for today. All right. Any questions for me, guys? Any questions? No. Then I will stop recording now. And I'm gonna have